Alright guys, we're doing Ford Motor today. And I was going to do a shallow dive, but then I decided that this can't be the real story and actually dove deeper into the numbers, looked at some of their reporting, and found some very interesting data that got me super worried about this company. So I'm going to share that with you in a minute. Ford Motor, this company's been around for about 120 years or so. And it's a fan favorite. It's American classic. What's not to love? Mustangs, Broncos, all that. Trucks, F-150s. This company is, super favorite. But does that make it a good investment? We're going to find out. To try to answer that, I have tried to dive into the numbers. And I'm going to show you the rosy picture that they showed at first. So let's take a look at the price action, to start. How about a 5 years chart? It's been hanging around this like $12 mark for quite some time. It was really well played in the 2020s by everyone to ride this bull market up. But once January of 2022 hit, it's been on a little bit of a downtrend and now has stabilized around the $12 mark. So the price action is not too bad. This is the what the company stock price has been doing over the very long term, ever since 1973. It is notable that they do pay a big dividend. I'm just going to do a big overview of the company real quick. So to paint a picture of actually what's going on, then I'm going to dive deeper into the numbers, okay? They do pay a dividend. They just paid some kind of special dividend, 65 cents. And, they only paused, I think, during the 2020s, even though it's not reflected here. But if we go under the dividend tab, under the financials, then you'll see, how about quarterly? Then you'll see that they actually had a little bit of stoppage here between, March 2020 and 2021, December. So they do pay a dividend, and so that's not reflected in the rise of the price. Obviously, if they kept the cash themselves, the price would be higher. So they are trying to look out for the investors. And I wanted to put into question how sustainable that is. Like, I wanted to know, okay, Ford Motor, can you still keep paying these dividends? And moreover, the real question I wanted to ask is, how are you going to survive a recession or a slowdown in your business? Because looking at the numbers, it became obvious to me that there's a severe weakness in this company. So let's just take a look at the surface numbers and work down from there, okay? The surface numbers don't look that bad in the beginning. So if we go to quarterly here, I like to do that because it gives me a bit more definition. Let's take a look at the revenue, shall we? So revenue, not bad. Record quarter, last quarter, previous quarter, 44 billion. It's not bad. Annualize that. That's like 160 billion per year. That's huge, for a company like this. That's great. How about, we go to net income. Okay, net income looks like, they made some money last quarter, 1.29 billion, but they're actually down 1.5 billion on the year. All right. So if we go to annual again and we scroll down to net income, you'll see that they're actually down 2 billion, for 2022 so far, following a monster year in 2021. But then again, who didn't have a monster year in 2021? Everyone had a monster year. So let's go back to quarterly. Let's take a look at some other numbers. Have they been diluting the shares of the company? The answer is no. So they are looking after the investors. Look at a lot of these metrics that investors would normally look at. Look fantastic. Okay, so dividend, free cash flow per share. Okay, most of the times is positive, right? Profit margin, not terrible. The outlier positive years kind of outweigh the negative ones. So for the most part, you think that, okay, these guys kind of know what they're doing. Now let's go to the statistics. You see some mind-blowing figures here. The market cap of this company, the total value of the company is 48.28 billion. However, the enterprise value is 104.46. Are you catching this? If you're good at math, they'll tell you that they're into a lot of debt. Okay? Now, these guys are not a bank, although some would argue that they are a bank, because they have their own financing wing. Ford does, and that financing wing is actually a bigger part of the company than the company that makes, the part of the company that makes cars and vehicles. Can you believe that? It's craziness, but it's true. So I looked at their report, and it actually more money goes through there. So, but they're not actually, supposed to be a bank. So they shouldn't be operating with that much cash, but they are. Let's take a look at the balance sheet to figure out what the balance sheet says about this, huge debt. So cash and cash equivalents, 82.7. When I saw this, I jumped off my seat. Okay, figuratively, not literally. Total debt, 139 billion dollars, which leaves us at a net cash position of minus $56 billion, more than the market cap of the company. That's a lot, okay? A lot. So there's more cash per share than the share is worth in debt. Let's take a look at some statistics figures here. A lot of it's NA because they had perhaps a negative quarter. So EV per free cash flow is NA. All these metrics are tough. So PS ratio, price to sales ratio, is a good one to look at. I guess that's pretty good. Forward PE is also pretty good. No PE ratio because there's no earnings at the moment. So a lot of these metrics that, investors use to evaluate stuff, and especially when they look at this dividend, they're like, oh, what? Dividend yield is 9.73%? Crazy. That's because of the special dividend. Here's a worrying factor if you're looking at this special dividend, is the payout ratio. Do you know what that is? 102%. So payout ratio is how much of the earnings of the company are you using to pay the dividend. And in this case, they're using 200%. They don't have the money. They're basically going in debt to pay out dividends, special dividend. Why would you do that? They care too much about, returning money back to the investors, and not about the company health and perhaps its ability to withstand a recession. And you might be thinking like, all right, but that's not that bad. Did you see all the revenues figures and everything else? And they can still pay out their dividend. Well, can they? Let's go back to this positive picture that they were painting for Ford Motor, right? Cash and cash equivalents. Let's take a look at that. Oh no, look at this, 82.7. Is that a real figure? We'll find out soon enough. $82.7 billion. Okay, so it's basically the cash and cash equivalents, $25 billion, and then short-term investments, $57.66. Those are basically like financing, probably loans that they've given out to their car buyers. So total current assets, 116 billion. Total assets, this includes everything from like their plants, their current vehicles that they haven't sold, land, everything, 256 billion. Total liabilities, 212 billion. Okay, so far so good, right? How about long-term debt? 88.81 billion. Oof. Okay, current debt, 50 billion. Ooh, accounts payable, 25 billion. So we'll go into this in a little more definition in a sec. Total debt, 139 billion. What I did was I went in, okay, and I found some reports from the company so we can take a better look and see what these numbers actually mean, what's behind these numbers. So I went into their report here, into their financial statements, and I tried to look at these lines. Let me see if you guys can see those lines. Yes, it's going to be hard to see on the phone. Maybe you can zoom in, but on the desktop you should be able to see it. So here are these cash and cash equivalents that we're talking about. And now we're going to put their ability to withstand a recession into question, okay? All right, so they've broken it down into the Ford Motor Company and then their credit wing, okay? But we're going to look at the consolidated because, it actually helps to look at them both and then consolidate it. First, cash and cash equivalents. All right, so cash equivalents are basically actual cash that's sitting in the bank, or like short-term deposits or short-term treasuries or something like that. That's having some yield, but basically you can cash that in within a reasonable amount of time. So that's cool. Marketable securities, these are basically the own stock of some other company or one of their own companies or whatever, or little startup investments that they've made into companies that they hope to acquire their technology later or something. I don't exactly know what they are, but it's basically stock of other companies, or, if you have a stock of a company, it's your company. So basically, anyways, bad joke. So this is the real one here. Ford Credit Finance receivables net 38.7 billion. Okay, so this money right here, unlike this 25 billion, this 38 billion is under question. Okay, that's money that people owe them. Let me see my mic level here. Should be good. That's money that people owe them, and that's under question. If there's a recession that hits, that number is going to go down by a lot. I don't know how much percent. 15, 20% down, sometimes more. You know what else is going to go down? Marketable securities, stocks. What happens in recession? Stocks go down. Okay, investments pull away. All right, nobody wants to take any. So this is going to go down. Marketable security is going to go down 15, 20, 30, 40, 50%. Okay, so that's 10 billion here, another 10 billion here. Trade and other receivables net, that number is also going to go down. Inventories, the value of the inventory of $14 billion worth of cars that they have right now, or whatever their inventory consists of, that's going to go down. That's not going to stay the same, right? If they can't sell the cars, they're going to get discounted. So that inventory is going to get knocked down another 10% or more. Okay, so that's another $1.4 billion here. So assets held for sale, it's irrelevant. Other assets, I have no idea what the other assets are, but doesn't necessarily matter too much. The point I'm trying to make is that these assets will be severely impacted in the face of a recession. Look at this. Ford Credit Finance receivables net $49.9 billion in their finance wing. Net investments in operating leases 21.8. Okay, that's probably going to stay pretty static, but this is going to go knocked down. Net property, the valuation of their property probably going to get knocked down in a recession. Okay, property is going to get knocked down. Equity and net assets of affiliated companies probably going to get knocked down, right? Other assets, doesn't matter, we can't comment on it, but it seems to be a pretty big chunk of other assets. Okay, so this number here, 256 billion, that's fictitious. It's not real. Okay, that thing might get knocked down by like 20-30%. So we're looking at a really severe inverse of this asset side of the equation. But you know what's not going to change? Their liabilities. Their liabilities are going to stay the same. All right, and let's take a look at that liabilities. Okay, payables, fine. 26 billion or something, 25.6. Other liabilities, deferred revenue, 21 billion. Okay, with the scary number, look at this. Ford credit debt payable within 1 year, $49 billion. So they got to come up with $49 billion in a year. If we have a recession 6 months, this company's screwed. So total current liabilities 53 billion. And look at this long-term debt, guys. This is a lot of debt to be carrying. You know how we calculated that, net debt was 56 billion? Well, look at this. Let's go back to this, to the stock analytics, stockanalysis.com. We'll go to statistics, the shortened balance sheet here. So total debt 138, out of this, okay, 69.6 long-term debt. So that's, that's quite a bit. That's not gonna get knocked down in a recession. That's the liability side of the equation is static. Okay, so just keep that in mind. So all of a sudden, if we decrease this number by 50 billion, company's worthless. It's just a brand. It's just a brand. That's all it is. So, look, is this gonna happen? Is this company gonna go broke? It's happened pretty much before or close to it. Okay, many times the company. Look at this. The company was worth like $1 or $2 here back in 2008. So if there's a severe recession, this company is gonna get knocked so far down. It's gonna need a bailout like other U.S. automotive makers. Okay, like these guys, they don't finance for emergencies, and it's understandable why though. Okay, it's understandable why, because they have to compete. They have to. Number one, they need investment from investors, from stockholders. They need people to buy their stock so they can invest into their company. They need debt so they can invest in their company. And why they keep investing in the company? Well, number one, they need to keep the wheels turning, no pun intended. But two, they have to keep up with the competition, right? There's very good competition coming out of all parts of the world, including our very own United States here. And they have to keep up. The car maker that is not spending money on research and development is gonna fall behind, gonna get left in the dust. Their market share is gonna shrink. They're not coming up with new interesting products to satisfy consumer demand, and they're gonna go in the dust. So the conclusion from all this is that car making is just a really tough business to be in as a company, and you have to really be ahead of the game in order to increase market share, increase profitability. You have to be razor sharp with everything that you do. By the way, another thing that worries me about this company, if you didn't know, is they have pension liabilities. I forget which part of the accounting they fall under, but these dudes are paying pensions. What company nowadays is paying pensions? This is some old school stuff, okay? Some old school stuff. So anyway, that's another thing to add that's onto their liability list that's weighing them down as a company. But back to the conversation at hand is, yes, they're automaker. They have to compete. They have to reinvest a lot of the money that they own, and they have to keep the investors happy, so they keep paying all the dividends. And there's been some financial gymnastics to try to make the company look good in some metrics. But if you dig down into numbers and what actually is going on, the situation is quite a bit more dire than it seems. And I have a feeling that it's been this dire for quite some time. Let me show you what I mean. Under the financials, under the balance sheet, if we go to quarterly, I want you to look at these numbers here. Where was it? Right here, look at this. Net cash versus debt. They were down in 2016 at negative $125 billion. I don't know why it ping-ponged like this for such a long time. I don't know the company events that happened during those years, but this chart is pretty worrying, to say the least. This situation has been improving since 2020, though, so we'll give them credit to that. But it seems like they're always teetering on the edge of complete collapse, just judging by their numbers. If you have some insight about this company and you feel like, I'm not painting the accurate picture of the company, let me know why. Tell me why this company deserves investing in when they have more debt than value of the company, even though they're not actually a bank, but I guess they're trying to be a bank for their own purchases of the cars. When they have so many liabilities, like pension liabilities, I think they're about $5 billion or so. When their asset side of the equation is at a complete risk given a recession, to get haircutted by 20% or so, leaving the company worth about zero. How much is a brand worth to you? You know, how much will a company pay for a brand that is currently worth, $48 billion? Do you think a company is gonna just buy the name Ford for $48 billion if the company is worth nothing, the business is worth nothing? And who's gonna buy it? All the other car makers are gonna be in trouble too, right? Is Tesla gonna buy Ford? Which company is gonna be healthy enough to buy a name for a few $1 billion? So this thing, I think, is only a good investment if the economics ahead are good and you think that Ford is going to continue to dominate and continue to get market share. I looked at the numbers of market share. I don't have the page number of the report right now, but basically they're about flat. They take a little market share at home. They lose a little bit internationally, so it's about even over the past few years. But if you think that Ford is going to outcompete everyone and going to improve in efficiency and just really take the bull by the horns and ride the sucker better than anybody else, then fine. But why would you, as an investor, take that risk when history has proven that they're going to be, competing at the status quo? There's a chance of new entrants stealing market share. We're not going to name any names, okay? And other automakers have proven that they compete just as well. So I need some reasons to own Ford right now, okay? Because to me, it just seems like they're always on the edge of failure. All right, I'm going to leave it right there. It's been fun looking into Ford. If you have a company you want me to review, give a shallow dive on, or even a deeper dive, let me know what it is in the comments. Or if you disagree with me about this company, I want to know why. Seriously, I seriously want to know why. All right, that's it for now. Peace out.